Hello and welcome to Livewire Markets. My name is Chris Conway. Today I'm having a conversation with Dougal Maple-Brown from Maple-Brown Abbott. Dougal applies a value lens to the Australian share market and he's going to be talking to us about the risks and opportunities he's currently seeing. Dougal, it's great to see you again. Thanks for sitting down with Livewire.
Thanks, Chris. Pleasure to be here.
Now, Dougal, you've argued that large parts of the Aussie market are priced for perfection, particularly in some of the big industrial and financial names. We're only a month into 2026. It's already been pretty volatile. What are the most important themes that you're looking at that might determine whether those valuations hold or unwind from here?
Yeah, thanks, Chris. I remember that episode I filmed with you on Livewire, and I talked about the some of the extremes, and I would argue that it's already started to unravel. Basically, we had a very good final quarter in 2025, and indeed January's been pretty strong as well. So what's happened? The D-rate of some of those favoured stocks is in full swing. We also monitor PE spreads between the rich and the poor. Those spreads have been coming in. And then we can go down to the individual stock level. You can see stocks like CBA, which peaked at 30 times middle of last year, are now down at 24 or 25. So the D-rate's definitely underway. The second thing I think is fair to look out for, and I'm filming this a day before a Reserve Bank decision, but interest rates, rising rates are not going to help those expensive stocks. The market's forecasting rates to go up tomorrow, and so that's already been priced in, obviously. But rising rate environment's not going to help those favoured stocks either.
So, Dougal, I know you like to apply a value lens, and you're talking about some elements there where things are starting to happen. So, are stocks starting to appear on your radar, or are you waiting for a little bit more downside before they become really appealing? I guess more broadly, what's your outlook for value over the next 12 months without asking you to crystal ball anything? And then, what's the evidence that you're using to draw those conclusions?
I think the market's still pretty hot. Again, it's not quite as hot as it was. At a market level, Australian Stock Exchange peaked at about 20 times forward earnings. It's like a 20-year high. Today, it's probably down to about 18 times. So, yeah, it's come back a wee bit, but not an awful lot. The outlook for the asset class as a whole is pretty tepid. The outlook for value, as I said earlier on, I'm still pretty confident, and say some of those things are already starting to happen. The PE spread I mentioned, that's the spread between we look at the deciles, most expensive decile and the cheapest decile. It's come back a long way, but it's still relatively expensive compared to history. So yes, value's had a good run for 6 months or so, but we still think there's a fair bit more to go.
Dougal, just for those playing at home, I know you don't think about markets in absolute terms like this, but you were just talking about the PE. You said it was at 20, it's come back to 18. I think historically the ASX is around 14. For someone like yourself that applies that value lens, what's the magic number? Is it a 12 or 10 where you start to go, geez, we're looking pretty good here in terms of the way we think about the world?
Good question, and I agree with that. 14-ish is the long-term number for Australia. As one of my colleagues regularly points out, whether it be a market level or indeed a stock level, they really come back to average and stay there. So if they're coming from 20, they don't sit at 14 and stay there. They generally keep going down. Now, whether that's the case this time, who knows? In our multi-asset funds, yes, we're underweight Aussie equities, so that's true to form there. And in my Aussie equity accounts, I've got a fair bit of cash as well. So we haven't moved that position yet.
Dougal, let's take the other side of the base case. What potentially could you be wrong about it? Is it the AI, productivity and still excitement that could, see markets, that I'll buy the dip thing and take off again?
I think there's a lot more risk to the downside. The risk to the upside is where I could be wrong, I suppose. I would put that in firmly in Mr. Trump's hands. Which is hard for I think a pretty sensible value investor trying to make decisions based on him. So in my opinion, he needs both the US economy to run hot and the US share market to remain strong up to the midterms later this year. So that's October, November. If he can do that, and I think he's got some levers he can pull on a 6-month view. President can't control the economy forever. If he can do that, then it's likely that the US market will hold up, and so will ours. Even there's some pretty key differences. I've already mentioned the interest rate environment in Australia. Say decision tomorrow, but the market's forecasting at least one, if not two, rate rises in Australia. Contrast that in the US, where the market there is forecasting one or two cuts during the year. So the US market, might get supportive of the rate cycle, which we are unlikely to have here in Australia.
Dougal, how is your portfolio currently set up? So talk to me about where you're overweight and underweight.
Portfolio is still pretty defensively set up, but to be very clear, it's based on valuation. But again, it's got the added benefit if one of the myriad of risks that are out there comes to fruition, then the underlying businesses that we own are pretty defensive. So in that regard, we like supermarkets, we like general insurance, we've got quite a bit of energy. And on the flip side, we're heavily underweight the banks, and obviously the techie growthy names. Finally, resources, bit of a mixed bag. As I said, we're overweight energy, but we've got no gold or rare earths or some of those more sexy commodities.
Talk to me, Dougal, just about the thesis on energy. Is it because of underinvestment over a long period of time, the oil price, some of the other energy elements, or is it a combination of a whole bunch of those things?
Combination, like everything in life, Chris, but fundamentally, particularly of late, energy was the only of our commodity stack, the only commodity trading a long way below our long-term price. Whereas, iron ore is $40 more than we think it is long term. Copper's a long way, and then before you even get to the gold and the rare earths. So fundamentally, we can see some value there, and yes, that value will be realised over the medium term, like all our calls. Investment in that complex is getting less and less. Demand is still at record highs. It's not going to grow much from here, and it'll fall one day. But fundamentally, it's because that's the only commodity trading below our long-term price.
So a bit of a cheeky question here, but after the obliteration that we saw on Friday night in gold and silver, are they still miles away from anything that looks like anywhere near value for you?
Yeah, long way away. And again, I haven't seen the exact numbers, depends on the commodity, but some of them have given up like 2 weeks of gains, even though, there were some massive falls on Friday. They're back to where they were, not maybe it's a month of gains, they're back to where they were at the beginning of January. So if we thought they're expensive, then that view hasn't changed.
Dougal, you've been pretty vocal about the risks of paying too much for perceived safety. So how do you think about the trade-off between value and quality today, particularly when some of the markets, those popular stocks that we've been talking about, they look expensive, but they're still operationally reasonably strong?
As I said earlier, this is starting to turn. We had a chart in our quarterlies, which I can send you, called derating of the darlings. So what we did there was we looked at the highest PE these stocks have traded since January 2020, so roughly since the start of COVID, and compared them to December 2025, so the end of last quarter. Now, the most extreme one was CSL, which you've heard me speak of before. CSL peaked at almost 50 times in 2020, and today it trades on 16 or 17 times. So a discount to the market, quite unbelievable. Not surprisingly, we have bought CSL. Okay, so in some cases where that derating has been extreme, we've bought it. Similarly, one of the others on that chart, which we've bought, in fact, the only other one on the chart is Woolworths, the supermarket. We've had a lot of Coles that's done well. Woolworths has been significantly derated, and so I've now bought some Woolworths. So they're the two that we have acted on. But the rest of the chart, and again, I'm so happy to send it to you, what strikes us is that even though they've come down a lot, most of them still look pretty expensive. So again, the two biggest ones I've highlighted here, CBA said come down from 30 to 25 times, but for a stock with minimal earnings growth, a bank as such, that still looks pretty rich to us. So we haven't bought any CBA. Similarly, Wesfarmers, which is the owner of the Bunnings hardware chain, that's come down from a PE in the high 30 times to the low 30 times. Now, that stock is forecast to grow earnings, low single digits, 3 or 4%, say, over the next few years. Even though it's come back 6 or 7 PE points, we still can't see why you would pay over 30 times for 3 or 4% growth. So we haven't bought any Wesfarmers.
Let's talk about capital discipline. Last year on the ASX, there was a lot of misadventure when it came to capital discipline. So in this environment, Dougal, what are some of the red flags that you look out for that would cause you to reassess, maybe a holding or a company that you've got in coverage?
That's a super question, Chris. And it's one of the hardest things we do, frankly.
Yeah.
As part of our investment process, I think I've talked to you before, we have a thing called a value trap checklist that helps us to try and identify the sort of things you allude to, whether it be an acquisition or too much gearing or whatever. To be clear, in our process, it won't stop us owning a stock, but at least this way we come into a stock with eyes wide open, and of course require a higher return if we see some of those flags. I won't go into all the herbs and spices of the flags on that checklist. But the biggest, by far, which might be good for your viewers, and it's what 30 years and scars on my backs, is when you end up taking both operational leverage and financial leverage. So as a value investor, we almost always have to take one of those. Typical case, earnings have a bit of a stumble, but the balance sheet is okay. We're happy to make the investment. What you don't want, and sometimes you end up this way, is both operational leverage and financial leverage. Then you can lose your shirt pretty quickly. I won't go through all our worst stock calls over 30 years, but we've had some, obviously. We own Star, the casino, and I'm pleased to say I got out at sort of $1.50. That stock had some operational leverage. It didn't have financial leverage when we bought it, but the leverage started piling up, and we got out. Because you say we don't want to own a stock with both, and today that stock's about 10 cents. So that's a good call to get out.
You talked there, Dougal, about the premium that you would want to see if you are going to take on one of these stocks with either of those two leverages. Is there a minimum amount, or is it literally a case by case? You look at the numbers and then you'll say we need to get an extra 15 here for this scenario.
No, it's pretty case by case because all the risks are slightly different. And also, to be fair, also on us, it depends on the returns on offer for the broader market.
Right.
So if market returns are high, then you don't have to go down this path. If market forecast returns are low, as they currently are under our lens, then you have to start taking these risks, and the type of premiums you'll demand will vary depending on the situation.
Let's talk a couple of stocks. You've already given us Woolworths, you've already given us CSL, but a couple that you're bullish on right now, perhaps maybe the best performer from last year and even a recent addition.
Added the most alpha last year was ANZ Bank. So notwithstanding we are underweight the banks, we had a lot of ANZ, purely on the relative call. As I've said a couple of times now, middle of last year, CBA was on 30 times forward earnings, and ANZ was on low teens, 12 or 13 times. ANZ has re-rated positively. 12 or 13 gone to 15 or 16 as CBA has been derated. So that's been an excellent call. To your question though, we still have a lot of ANZ. So it added a lot of alpha last year, and the investment thesis is still the same. It looks too cheap relative to its peers. Now, not as ridiculously cheap as it was in June last year, but still cheap. So we still hold a lot of ANZ, but to be clear, we're still underweight the banking sector. On the flip side, I'll give you a loser, but we think we're still there. Amcor, it's a global packaging company. Today it trades on about 10 or 11 times forward earnings. So I said earlier on, the market peaked at about 20, down to 18. We think that discount is too wide. On the plus side, a packaging company isn't likely to be disrupted by AI, but equally, it's low growth. We acknowledge that. But that's fine. At 10 and 11 times earnings, you're not forecasting a lot of growth. So that looks like a pretty reasonable investment.
And the acquisitions they've made, Bemis, and then the one more recently, comfortable with the way that they are progressing?
The good and the bad thing about Amcor is it's a company largely built on acquisition. So that's one of your red flags you'd normally look at. The good thing about that is they've done lots, literally lots of all shapes and sizes. So I think they're pretty good at getting the costs out, getting the synergies, and then moving on to the next one. So far there've been no indications that it hasn't worked, and the synergies are on track as far as I know. Again, they report on Wednesday or Thursday, so
Thursday.
I could look silly in a hurry, but yeah, as we know today, everything's on track.
Dougal, let's finish up. I always love asking this question of all fund managers. I find people often learn more about a stock that they sold recently than what they've been buying. So talk to me about one that you've sold, whether it hit your valuation and you moved on, or the other side of it, even if it didn't turn out the way that you thought it might.
We haven't had a lot of turnover, is fair. One we have sold is Brambles. So a bit like Amcor, global business, pallet people. It's been a fairly long-term holding in the portfolios. Why did we sell it? Because two reasons: earnings have done exceptionally well, and that's a good thing. But on any long-term earnings chart, it was off the screen. And secondly, not only were earnings high, the PE was as high as it's probably as has ever been, frankly. So high earnings and high PE. Thanks very much, Brambles. It's a great company, but we thought it looked pretty full. So we've trimmed and now totally sold out of Brambles.
Yeah, no doubt made a healthy profit on that one. So well done.
We did.
Dougal, thank you so much for taking us through that. Appreciate you sharing your insights with the Livewire audience. That was great.
Thanks very much, Chris. And of course, be with us over reporting season.